Welcome, audience and finance enthusiasts, to Mind Games, the Finance Edition. Today we're delving into the riveting subject, the efficiency of markets. Are they as efficient as some experts claim, or do human behaviors create pockets of inefficiency? I'm here to guide you through both sides of this fascinating debate. Let's start with the efficient market hypothesis, or EMH, developed in the 1960s by Eugene Farmer. EMH posits that stock prices reflect all available information. The theory argues that given this inefficiency, it's impossible to consistently achieve returns exceeding average market returns, or beta as it's known, on a risk-adjusted basis. But is it really that straightforward? Let's peel back the layers. Eugene Farmer, the father of the efficient market hypothesis, was a towering figure in financial economics. His groundbreaking work, which later earned him the Nobel Prize in Economic Sciences in 2013, began in the context of a rapidly evolving financial world. Post the Second World War, the global economy was transforming, and with it, the nature of financial and securities markets. Farmer, then a young researcher, noticed the unpredictable movement of stock prices and began questioning the prevalent theories of the time. The efficient market hypothesis emerged as a challenge to the conventional wisdom that savvy investors could consistently outperform the market. At its core, EMH suggests that stocks always trade at their fair value, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. The hypothesis is built on the assumption of market efficiency, which itself rests on three forms of market information: weak, semi-strong, and strong. These forms describe the extent to which stock prices reflect historical data, publicly available information, and sometimes insider information, respectively. As we dive deeper into the world of EMH in this podcast, we'll explore its implications, the debates it has sparked among economists and investors alike, and how it has shaped the investment strategies of millions around the globe. We'll also look at the criticisms and the anomalies that challenge EMH, like market bubbles and crashes, and the role of behavioral economics in understanding market dynamics. So buckle up as we embark on this journey through the intriguing landscape of the efficient market hypothesis. Now, contrasting with EMH is the field of behavioral economics, which infuses psychological insights into economic theory. It suggests that investors are not always rational actors. They are influenced by cognitive biases, emotions, and social factors. This perspective argues that these human elements can lead to decisions that deviate from those predicted by traditional neo-financial theories or neo-economic theories. Behavioral economics challenges the efficient market hypothesis by asserting that these irrational behaviors can affect market prices, leading to inefficiencies that savvy investors can exploit. One of the key figures in this field is Richard Thaler, a Nobel laureate renowned for his work in behavioral finance and economics. Thaler's research demonstrated that real-world investors frequently behave in ways that are inconsistent with the rational, profit-maximizing assumptions of the efficient market hypothesis. He introduced concepts like mental accounting, where people treat money differently based on subjective criteria, and the endowment effect, where individuals value an owned object higher than its actual rational market value. These and other findings suggest that investor behavior often deviates from the rational model assumed by Farmer and the efficient market hypothesis. Thaler's work, along with that of other behavioral economists like Amos Tversky and Daniel Kahneman, highlights situations where emotional and psychological factors lead to predictable biases. For instance, investors might overreact to recent news, leading to stock price movements that do not reflect true, legitimate value, or they might follow herd behavior, creating bubbles and crashes that are hard to reconcile with the idea of efficient markets. We've seen examples of this in the past with the 2000s.com crash and subsequent this boom and subsequent crash, along with the 2008 housing market crash. In our upcoming segments, we'll delve into the specific case studies and experiments by Richard Thaler and others, which illustrate how human quirks and biases can lead to anomalous market behavior. We'll also explore how behavioral economics not only questions the foundations of EMH, but also offers a more nuanced understanding of financial markets, one that accounts for the complexity and unpredictability of human behavior. So, as we continue to unravel the layers of the efficient market hypothesis, join us in examining its fascinating interplay with behavioral economics and how its rivalry shapes our understanding of our current financial world. Consider market reactions to major news events. According to EMH, the market absorbs news instantaneously, adjusting prices to reflect this new information. But is this reaction always rational and efficient? Behavioral economists point out instances of this of overreaction or underreaction to news, driven by herd behavior or panic selling. These emotional responses can create temporary mispricings, an opportunity for investors to capitalize on. Consider market reactions to major. To fully appreciate the intricacies of the efficient market hypothesis, we must dive deeper into its principles. EMH is grounded in the belief that the market is composed of many well-informed and rational investors. These investors, often referred to as rational actors, are assumed to analyze all available information when making investment decisions. The theory posits that as new information becomes available, these actors quickly utilize it to update their investment strategies, thereby adjusting the market prices to an equilibrium that accurately reflects the true value of an asset. This, in the hypothesis, happens almost instantaneously, leaving no margin for an investor to capitalize and make a return on. The notion of rational actors in this hypothesis is crucial. These individuals are not swayed by emotions or biases, but base their decisions purely on logical, statistical, and rational analysis and the available data. They're considered to be consistently objective, calculating the intrinsic value of securities based solely on fundamental factors like financial performance, market conditions, and more. Furthermore, the hypothesis argues that the collective actions of these rational investors result in a market that efficiently prices securities. This efficiency comes in three forms. Weak form efficiency. Here, the current stock price reflects all past market information, such as historical prices and volumes. According to this form, technical analysis, which tries to predict future stock prices based on past trends, is deemed completely ineffective. Then we have semi-strong form efficiency. This form posits that the stock prices not only reflect historical data, but also publicly available information, including news, financial reports, and economic data. Therefore, fundamental analysis, which evaluates stock based on financial and economic analysis, is somewhat considered futile in yielding excess returns. Then we have strong form efficiency. This is the most stringent form. It suggests that stock prices reflect all information, both public and private or insider. If markets are strong form efficient, no investor, not even insiders with proprietary information, can consistently achieve abnormal returns. The key factor here is consistency, because everybody accepts that securities markets can have some irregularities and anomalies, as they're called. But in the long term, the hypothesis posits that the securities markets and other markets will always be efficient. Each of the forms that were stated implies a different degree of market efficiency and has different implications for investors' investment strategies. However, critics, particularly from the behavioral economics camp, argue that the real-world markets often deviate from these ideal conditions. They point out to clear cognitive biases, emotional influences, and social factors that lead to decisions that may not be entirely rational or profit maximizing, creating market inefficiencies that can be exploited. Now let's turn our focus to the other side of the debate and examine how behavioral economics systematically challenges the efficient market hypothesis. Behavioral economics, at its core, introduces psychology into economic theory, suggesting that markets are not always rational and efficient, as EMH proposes. This perspective brings to light the systematic ways in which human behavior deviates from the purely rational, profit maximizing decisions assumed in the hypothesis. Firstly, behavioral economics highlights the impact of cognitive biases on investment decisions. Cognitive biases, like we talked about in earlier episodes, are psychological patterns that can lead to irrational behavior. For instance, one bias, known as the overconfidence effect, is where investors overestimate their ability to predict market movements, leading to riskier bets than a purely rational analysis would suggest. Another is the confirmation bias, where investors seek out information that purely supports their pre existing beliefs about a security and ignore all contradicting evidence, potentially leading to misjudged and irrational investment choices. Secondly, behavioral economics emphasizes the role of emotions in financial decision making. Emotions like fear and greed can significantly influence investor behavior. During a market downturn, fear can lead to panic selling, causing prices to fall below their intrinsic value. Conversely, greed can drive excessive buying during a bull market, inflating prices beyond their reasonable intrinsic fundamental value. These emotional responses can create price patterns and market anomalies that can contradict the efficient market hypothesis. Moreover, behavioral economics also sheds light on herd behavior in financial markets. Herd behavior refers to investors following the actions of the majority of the market, often irrationally, leading to market bubbles or crashes. This collective movement can be driven by a fear of missing out or a desire to conform to the perceived wisdom of the crowd, rather than individual, rational analysis of market information. Richard Thaler, like stated earlier, a prominent figure in this field, has conducted extensive research demonstrating these behaviors. His work on studying market anomalies, like the January effect, where stock prices tend to rise more in January than in other months, challenges the notion that markets are always efficient and prices always reflect all available information. Behavioral economics, or BH, doesn't just critique the efficient market hypothesis. It provides an alternative lens through which to view market dynamics. It suggests that markets are complex systems influenced by a mix of rational analysis and human psychology. This perspective argues that understanding investor psychology is crucial for a more complete understanding of market movements. As we delve further into this debate, we see that the latter brings a crucial dimension to the understanding of financial market, that being behavioral economics. It recognizes the ever-growing and ever-existent human element in economic activities, reminding us that markets, after all, are simply human constructs, influenced by the diverse and complex nature of human behavior. To deepen our understanding of how markets may not always be as efficient as posited by the EMH, let's explore specific examples and research, particularly from Richard Thaler, which highlight market inefficiency. Thaler's work in behavioral economics provides compelling evidence that markets often behave in ways that are inconsistent with EMH. One notable example is the concept of a closed-end fund puzzle, extensively studied by Thaler. Closed-end funds, which are mutual funds traded on stock exchanges, or exchange-traded funds, or ETFs, often experience significant discrepancies between the stock price and their net asset value of their underlying assets. A very famous example of this is the mutual fund that is exchange-traded called Cuba, CUBA. This is the ticker for the fund. But this American fund has no connection to Cuba whatsoever. Now, that would be illegal, obviously, because financial activities are not allowed in Cuba by the American government, and there is no securities market in Cuba. What is interesting about this is this mutual fund rose by over 70% the day that President Obama stated that sanctions on Cuba were being lightened. This mutual fund, this exchange traded fund, which had no connection to Cuba other than its ticker, had risen by 70%. And the fact that this is an ETF, which has underlying assets, this means that we can calculate how much each investor is paying for each asset. That means for every 100 rupees or $100 of the underlying assets of the mutual fund, investors were paying 170 rupees or $170 for the same thing. They were losing $70 or rupees. This shows the irrationality of investors and how simple sentiment can cause rapid changes and rise in the market. Another example is the equity premium puzzle, where Thaler and other economists noted that stocks historically have offered a much higher return compared to bonds, more than what could be justified by the relative risk of stock versus bonds. This suggests that the market's pricing of risk and reward might not be as efficient as the hypothesis posits. Furthermore, Thaler's research on mental accounting reveals how people categorize and treat money differently based on various subjective criteria. This contradicts the EMH assumption that money is fungible and that rational investors should be indifferent to such categorizations when making investment decisions. He's working on the anchoring effect, which was mentioned in an earlier episode, where people rely too heavily on the first piece of information offered when making decisions, also sheds light on market inefficiency. This can lead to stock prices being influenced by historical data or initial public offering prices than by current market information. Richard Thaler, along with other behavioral economists, has shown through these examples that market inefficiencies are not just theoretical possibilities, they are in some way anecdotal, but they are real-world occurrences. They demonstrate that investor behavior is often influenced by psychological factors and cognitive biases. As we further explore these insights into behavioral economics, we come to appreciate the complexity of financial markets. They are not just arenas of cold, calculating logic, but vibrant ecosystems where psychology does play a crucial role. Recognizing these human elements in market dynamics is crucial for a more comprehensive understanding of financial behavior, one that challenges the core assumptions of the efficient market hypothesis. This debate between the efficient market hypothesis and the behavioral economics has profound practical implications for investment strategies. It's not simply theory. Let's explore how investors might utilize this information. Firstly, contrarian investing. Please note that all of this advice is simply theoretical and is stuff that exists. It is not to be used as something to go off of. It is not to be used as advice in any way. This approach, contrarian investing, involves going against prevailing market trends or sentiments. If a stock or sector is widely unpopular, a contrarian investor might investigate further to see if this negativity is justified by fundamentals. If not, this could present an opportunity to buy. Next is value investing, rooted in the idea of identifying undervalued stocks. Value investing involves buying securities that appear underpriced by some form of fundamental analysis. Behavioral biases in the market can sometimes lead to certain stocks being undervalued, offering an opportunity for savvy, rational investors to come in. Then we have momentum investing. This strategy seeks to capitalize on the continuation of existing market trends. Behavioral biases like herd behavior can lead to trends persisting longer than what might be expected in an efficient market or to be backed up fundamentally. Momentum investors try to ride these waves, buying stocks that are trending up and selling those that are trending down. Arbitrage is a concept that takes advantage of price differences in different markets or forms. For example, if a stock is trading at a different price on two stock exchanges, an investor could buy at a lower price and sell at a higher price, profiting from the difference. Arbitrage is another concept that capitalizes on the fact that markets may not always be efficient, because if a stock is on two different exchanges, it should theoretically, based on the hypothesis, be at the same price, the fair value. Investors could also integrate behavioral finance analysis into their strategy, identifying patterns of irrational behavior among market participants and devising strategies to exploit these patterns. The key question remains, can investors consistently identify and capitalize on these inefficiencies? While behavioral economics suggests that opportunities exist due to irrational behaviors, exploiting these inefficiencies requires skill, analysis, and often a contrarian, rational mindset. It's also crucial to acknowledge that attempting to outperform the market carries its own risks and costs. As we all know, the great amount of fund managers who are paid to do this, who are not able to beat the market. In conclusion, a balanced investment strategy might involve a mix of passive and active approaches. By understanding both the principles of EMH and insights of behavioral economics, investors can be better equipped to navigate the complex and ever-changing financial markets. This fascinating dance between the rationality of numbers and the unpredictability of human nature. The market, it seems, is a complex ecosystem influenced by a myriad of factors, some logical, some emotional. Even Eugene Farmer, the architect of the efficient market hypothesis, acknowledges that EMH isn't the infallible truth, but rather the best model that we have at the moment. The admission underlines the inherent complexities of financial markets, not how wrong EMH is. It's a reminder that our models, no matter how robust, are simplifications of a reality that is shaped by the often unpredictable nature of human behavior. In conclusion, the market efficiency debate isn't black and white. While EMH provides a solid foundation for understanding market dynamics in the long term, behavioral economics offers valuable insights into the human elements that can disrupt this efficiency. Farmer's own acknowledgement of EMH's limitations is a powerful testament to the need for a multifaceted, non-black and white approach. As an investor, it's crucial to recognize the merits of both viewpoints, embracing the discipline and broad perspective of EMH, while remaining alert to the nuances and anomalies highlighted by behavioral economics, can lead to a more balanced and informed investment strategy. This synthesis of ideas not only enriches our understanding of markets, but also enhances our ability to navigate their complexities. In the world of investing, as in life, a balanced perspective that appreciates both the predictable patterns and the unforeseen variables is often the wisest course. Thank you, and please catch me on the next episode of Mind Games.